welcome to my channel, The Smart Investor. Let me explain to you what I mean by smart. I mean that I'm here to educate you. So let's not try to predict the market once again, but let's talk about what's important. What is important today, we're going to talk about irrational exuberance. What does that mean and what do we care? Well, I don't know if you've noticed, but the S&P is up and up and up and up. Several sessions in a row, right? So that means that it's doing pretty good. That also means that, are we off to the races? Should we be careful? Should we worry about irrational exuberance? What is that? Well, first of all, you need to know that this is a phrase that was coined by the Federal Reserve Board chairman in 1996, Alan Greenspan. And basically, what it means is this. It means that this was 1996. Now, I have to remind you, for those of you traders, that in 1999 to 2000, we have the dot-com bubble. But basically, prices went up, meaning that though it must be good because pricings keep going up, and it was feeding, it was positive feedback. The higher the stock went, the more positive people were, and the more they were buying, and the more positive they were, and it got bigger and larger and bigger until it exploded. And when I look at this, as you could see, it said that clearly sustained low inflation implies less uncertainty about the future, and lower risk premiums imply higher prices of stocks and earnings growth. Yes, because there is an inverse relationship between prices and yield. If I'm going to give you $1,000 forever at 10%, that $1,000 today is worth $10,000. If the rate goes to 5%, that $10,000 is worth $20,000 today. So the lower the yield, the higher the asset value. And that's what he said. Basically, we can see that an inverse relationship exhibited by price to P ratios and the rate of inflation in the past. But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contraction as they have in Japan of the past decades? He's basically saying, be careful. You're fooling yourself by thinking that the higher the stock prices go, the higher they're going to go because someone else is buying it. There must be something good about it, so therefore I should be buying, therefore the price should be going up. It's a feeding loop, a positive feedback. Do we have such a thing? Well, you need to worry about. Why? Well, because, don't forget, in the background, lurking behind us, is a potential recession. Some pretty important people, such as Jimmy Dimon from JP Morgan. Goldman Sachs is also putting a percentage in terms of a possible recession. So you got this thing lurking. You've got the $35 trillion lurking. What do we do? What do you think is going on? Recently, the U.S. employment fell by an additional 800,000. It was a revision, right? So actually employment is a little weaker than we thought. Do we have a recession? No, we're just saying employment was just lower than we thought. Can you afford a mistake right now? Because as valuations are rising and going up and up, the P ratio now is at 36. That's a huge amount. As a trader, as an investor, as someone that wants to make money in the stock market, you need to know where you are. Remember, we're not looking to predict the market, right? We're looking to take advantage of it, right? And when everyone is buying, you should be selling. Is everyone buying right now? I said that yesterday. I mean, if we keep going up and up, I'm going to say, yeah, everybody's buying. Therefore, you should be selling. Does it mean you should sell your position? Not necessarily. You could take an adversarial relationship. You could buy a put, on the options and make some money. But right now, it seems that the wind is pushing us. Nobody cares about geopolitical risk. Nobody cares about some of the voices that are saying, be careful. The Fed always has been wrong in terms of timing its decrease of rates with avoiding a recession. And valuations keep going up and up. I mean, it's okay for people to say, be careful, you should be doing this, you should be doing that, sell this, doing that. Yeah, but they don't know what your portfolio is, right? You know your portfolio. You're holding all these stocks and they're going up in value. We'll take a look at my portfolio in both of them, and I'm beating the market right now, which is great. But then again, I'm worried that this is too much. This is too fast. We should see a breather at some point. We should see a breather. We should see something happening, right? Unfortunately, right now, what they're doing, they keep pushing the stocks up, right? Because ultimately what you have is we are kind of eyeballing September 18th is when the Fed is going to be deciding. And everyone kind of know that they're going to lower the rates by 25 bips. So let's take this possibility. Comes to September 18th, the Fed looks at the numbers and said, you know what? It's not too bad. 25 bips is good, because then you could say, well, then my strategy, because now we're taking advantage of, we want to take advantage of the market, right? Well, I take advantage of the market because I think that rates are going to be small rate cut, right? So therefore, that's not good, because I want to go into, because that could also mean that you really can't get involved in small cap rate stocks, right? Because you want heavy rate cuts. So if you only have a small cut, 25 bips, and that's it, then what's going to happen is, I guess we don't have a recession, which is good. It means that the Fed is confident. I don't know how the market is going to read this. In that case, you have a soft landing. In that case, go for value stocks. Why? Well, because the Max 7s are already highly valued. You don't want to pile up in this thing, because then if that's the case, don't forget, then stocks are really going to take off. Now we're going up there in the stratosphere. Remember, we have geopolitical risk hiding in the background. We have the 35 trillion hiding in the background. We have high valuation. By that time, we're going to be at P of 40. We've never been that high. So we have small amount of rate cuts. Then therefore you want, and no recession. Remember, you don't want a recession. I don't know if that's going to be the case or not. And the Max 7s are too high. Then maybe you want to take a look at the value stocks, such as Fabrinet, which was up 20% yesterday. It all depends where you think this thing is going to end up. It all depends how you want to take advantage of the market. Don't try so much to get a recommendation out of me, a prediction, okay? Try to understand what's happening. Try to understand what's going on in the mind of those traders. I don't really know what's happening in the real thing, but all I could tell you right now, it would appear that we're slowing down. It would appear that you're going to have 25 basis points. By that time, the stock market is going to be very high. We have until September 18th to think about this. What do you think is going to happen between now and then? I don't think people are going to start worrying about the 35 trillion, okay? Because it's too soon. You need to worry about it, but not right now. You probably don't have a recession yet, maybe some numbers. I mean, the numbers came out, 818,000, but the market, it's okay. We will take a little cut, and that should be enough to manage this position. So probably the market now is not concerned anymore about the recession. So the coast is clear here. The coast is clear probably until September 18th. So what do you do between now and September 18th if you believe that you don't have a recession? If you believe, therefore, that only a small cut, probably not the best idea to go into small caps. Now, when I say go into small caps, obviously, I mean, small caps is less than $2 billion in cap rates, right? In market capitalization. That's a lot of companies, right? You're not going to buy all of those things, right? Because today, if I look at the numbers, the Russell was up 1.32 and the market was up 0.42. What is that telling you? Small stocks are beating big stocks right now, right? So this seems to be telling me that we're going to have many more cuts, lots of cuts. Therefore, because that's beneficial to the small stocks. So the market seems to be believing that. The market seems to be believing that even though I'm going to get a bunch of small cuts, which usually means, you want to slow the economy down because you may have a recession, they're saying, yeah, but we're not going to have a recession. It's going to be enough. We're going to have a soft landing. Well, if you have a soft landing, then we don't need to cut that much. You see what I mean? You see the dichotomy, right? If you're going to have soft landing, I don't need to get 5 or 6 cuts at a quarter. Just one cut in September, we're good to go. But if you think we need lots of them, I mean, you feel that we're going to need to do something to prevent the recession that's coming anyway to actually land and crush us on the head. And therefore, that's going to be a problem, because if you have a recession again, it's great to have a bunch of rate cuts, but the market, in my view, is negative. Although it should be good for the small stocks, which that seems to be implying right now. We'll see. I mean, The market was up 0.42, the S&P, but the Russell 2000 was up 1.32, 3 times better. What are we going to do? What's going to happen? That is what you need to worry about. That is what you need to focus on. So at the end of the day, again, it's understanding what is happening, understanding the players. Don't try to predict the market. Try to understand it. Okay? So do we have a irrational exuberance? I guess you could say yes. I mean, I've been going up and up, even though I've got noise in the background of potential recession. I've got noise in the background about the 35 trillion. I've got noise about in the background that unemployment seems to be weaker than I thought. I got geopolitical risk. Forget all that. The market is going up. I'm buying, and I'm buying when everyone else is buying. Bad idea. But then again, everybody's buying. You don't. You're going to have a soft landing. Only 0.25 basis points. The coast is clear. That is a challenge in the market. That's what makes it interesting. Because you're not trying to guess the understanding. You're not trying to understand what's happening. You try to understand what they are thinking. Do we have irrational exuberance or don't we have it? Now, if I look at the portfolio, let's take a look at, so the market is up 0.42%. My general portfolio, as you could see, these are all the position. Overall, I am up 1.4% on my general stock, and on my small stocks, I am up 1.15%. So I'm beating the S&P 500 on both positions today, again. Now you will notice, for example, on my general portfolio, you're going to notice that my call for the SPY, my TSC call also is up. I'm up 3.4. Even though my best position, believe it or not, is the put, the 24 put. That's actually also up by 3.9%. That doesn't make any sense because puts usually lose value when the market is up. Here, I am gaining value as the market is going up, even though it's a put. Now, all of my positions are up. I would like to obviously note that METC is up 4% today. Market cap 629, so definitely a small cap. Small cap are beating it. Small cap are doing good. And what does this company do? If I look at what the Ramaco engaged in development operation of sale of metallurgical coal, that's a coal company. Take a look at it. So my portfolio is doing fine. Now, obviously, what you should be doing or should be thinking about is, well, okay, so the market is up. I'm not worried. And probably, you should expect some sort of pullback. If you expect a pullback, get yourself maybe short-dated put to benefit from that short-dated volatility. And that is how you can benefit from it. And that is how you make money in the stock market. Remember, the stock market is a combination of all these people. It's a combination of all these people trying to understand and figure out what is happening. And what is happening is not always what is really happening, but what's really happening is what people are thinking and are acting on. If you listen to the social media all the time, you will realize very quickly, but the game is afoot. Remember, you need to look, you cannot look at this in a vacuum because they have their own position to talk about. Even when you look at, I've seen all these day traders are pushing on certain stocks and certain position. How could they, in good conscience, tell you to buy, Tesla or whatever? They don't know what you have. They don't know your risk position. They know their risk. But you do not understand the market. You do not understand the risk either. So watch out for that. Make sure that at the end of the day, you're totally comfortable with what's going on. Remember what happened in 1999 and 2000 when that bubble bursted. And it did burst. The NASDAQ lost 50% of its value. Now, of course, at that time, if you were to look at the P ratio, you're going to see that thing were way past where we are today. Okay? So it was really high. But we're not that far up either right now. Unfortunately, the issue that you're having is that you need to make a decision before. You need to sell when they're all buying. You need to be like Warren Buffett. What is solution? What is the answer? You need to be first. The answer is if they're talking about it, it's already too late. Right now, they're all talking about the coast is clear. I mean, Tom Lee and these guys, go ahead, it's going to be great. Yeah, it's going to be great. It's going to be great for a while until it's not great anymore. At some point, it's too much, right? And my concern is that they're all thinking in the back of the mind the way I'm thinking, like, oh, this is too good to be true. This is irrational. The word is starting to come out, irrational exuberance. It's starting to be used more, right? Once that word starts to come out, they're thinking, okay, at some point it's going to be too much. Well, I mean, there's nothing going on. The unemployment is okay. Recession is okay. I don't see the 35 trillion. Yeah, but there's an election. Who knows? They're going to talk about it. They're going to discuss it or not. We'll see. Right? And you're not going to hear too much of it in terms of discussion in the elections because nobody wants to talk about $35 trillion. That is too much money. And there's nothing you can do about it right now. And that's what happened in 1987 when the market lost 20% in one day. Okay? Talking about 6,000, 7,000 points. 20%, what is that? 20% in one day would be 8,000 points. Imagine you lose 8,000 points in one day. And at that time, they went out to the players and said, why did you sell on that day? What happened? Why did you sell 20%? There was not a valid reason for it. Okay? So, what do? We look at our portfolio. And what do we look in our portfolio? Well, in terms of value, look at Fabrinet is up 2.5%. ECL is up 1.64. IFF. PPG is up 1.59% in one day. These are great stock. The only issue that I have with a name like Fabrinet, for example, is that the P ratio, Fabrinet is, first of all, it's not a small stock, but the P ratio is already at 33. And that's getting a bit too high. Unless it's a value stock, you need to focus on that. There is a way to play this market as well that you should think of. If you think that there's a lot of volatility, unfortunately, I am not seeing a lot of volatility because when I'm looking at the VIX is standing at 16.3, right? And if you look at the volatility of the VIX, he has dropped since, I guess it was August, in the past 3 months, this is the lowest it's been. I mean, we had a peak on August 5th, obviously, but it was nothing until that day. So the thing with the VIX is that, well, yeah, but by the time it acts, it's too late. You can't act on it because it's already up. Right? You need to be the one that triggers before it happens. You don't want to trigger too soon. You don't want to start hedging too soon. You don't want to sell too soon. But at the end of the day, you can't sell the portfolio, buy, sell. That's nuts, right? So either you buy and hold and you wait, or you just let it ride for a while. And that's the question. And that's the issue you need to face, okay? So let's watch this market. Let's see what's happening with this irrational exuberance to see if it's going to keep going.